What's up guys and welcome back to Wall Street Millennial. On this channel and podcast, we cover everything related to stocks and investing. The American financial markets are by far the largest and most advanced in the world. In fact, according to Elroy Dimson, the US stock exchanges account for 56% of the total market cap of all stocks in the world, followed by Japan at a distant second place of 7%. Accordingly, there is a highly developed industry of asset managers, traders, investment bankers, and other professionals that has produced some of the world's richest firms and people. According to Forbes, about 10% of the world's 100 richest people alive made their fortunes in the finance industry, despite finance being a small fraction of the overall economy and a relatively less productive industry for society. That's because many parts of finance, such as asset management, require only a very small amount of manpower to run the business. A hedge fund managing a few $1 billion in assets might only employ a few dozen people to do their investment research and due diligence. On the other hand, a similarly sized oil company, for example, would necessarily employ many times that number of people to do everything from accounting, procurement, engineering, sales, etc. That means that hedge funds and other investment companies can pay top dollar for the world's best talent and make billions of dollars by playing or enabling the stock market casino. This also sometimes leads to questionable behavior, where finance firms bend or break securities laws to make an extra buck. In this video, or podcast if you're listening on Spotify or Apple Podcasts, we're going to take a look at 3 recent cases of the SEC busting these firms for breaking securities laws, including one where an $8 billion hedge fund unlawfully made $6 million at the expense of ordinary investors. We encourage you to read the official SEC press releases linked in the description below for the full information about this video's topics. This video is brought to you by Frontman, the skincare company with products designed specifically for men. They have everything you need from ridiculously fast acne treatments to products for ingrown hairs and a completely oily-free sunscreen to help you live longer and look better. Frontman's signature product, Fade, is a skin-tinted lotion that covers breakouts instantly while treating the underlying acne with dermatologist-approved natural ingredients. Getting rid of acne in 10 seconds just got real. We've partnered with Frontman to bring Wall Street Millennial viewers 10% off your next order using promo code WSM10 at checkout. Head over to befrontman.com to claim this limited time offer and break free from acne today. First up, we have a massive $186 million settlement between the SEC and subsidiaries of the major retail stock brokerage Charles Schwab. You're almost definitely familiar with this brokerage, and there's even a good chance you may have traded with them, as they're one of the so-called Big Four brokerages in the US. According to the SEC, Charles Schwab subsidiaries misled their own clients about hidden fees associated with their robo-advisor investment strategies. Robo-advisors are robot financial products whereby clients answer some questions and then the bot makes suggestions and sometimes even automatically invests the client's funds. They advertise their robo-advisor product as using a quote, disciplined portfolio construction methodology unquote, to seek optimal returns for clients. However, contrary to these promises, the robo-advisors allocated client funds in such a way that the brokerage's own data showed was actually suboptimal. In general, brokerages make money in a few different ways. One is by charging commissions or fees on account balances or on trading activities. In recent years, this revenue source has been declining industry-wide due to the rise of zero-commission trading and a shift towards low or no-fee accounts. Another way that they make money is by lending out the cash in their clients' accounts at an interest rate higher than the interest rate that they pay to their clients for the use of their cash. According to the SEC order, Charles Schwab subsidiaries deliberately kept a suboptimally large amount of cash in their robo-advisor clients' portfolios so that they could make more money by lending out that cash. In certain circumstances, cash made up nearly 30% of the portfolio. Also, the portfolios were set up such that the company would earn at least a minimum amount of revenue from the spread on the cash by loaning out the money. They did this while at the same time claiming that these robo-advisor products imposed no advisory fees or hidden fees, while in reality, in many market conditions, this suboptimal allocation would lower client returns by about the same amount as an advisory fee would. As a result of the violations, the brokerage's subsidiaries agreed to disgorge $52 million of ill-gotten gains and interest, plus a $135 million civil penalty. The director of the SEC's enforcement division, Gurbir Grewal, said the brokerage, quote, claimed that the amount of cash in its robo-advisor portfolios was decided by sophisticated economic algorithms meant to optimize its clients' returns, when in reality it was decided by how much money the company wanted to make. The conduct was egregious, and today's action sends a clear message to advisors that they need to be transparent with clients about hidden fees and how such fees affect clients' returns, unquote. This case just goes to show that despite how well known and prestigious brokerages may be, you can never be sure that they are always acting in your best interest as an investor. Next up, we have a Boston-based investment manager who recently agreed to pay nearly $7 million to the SEC to settle charges against it. The company engaged in an unlawful trading strategy whereby they would short a stock, then, using their status as a prestigious investment company, gain access to public offerings of the same stock but at a discounted price. They would thus make a near arbitrage by shorting the stock at the higher market value, then buying the stock off market at a discounted price. The firm did this 7 times within a span of just 3 months. They cumulatively made $6.5 million from this activity, essentially risk-free. The reason that they were able to do this is because companies frequently do follow-on offerings of their common stock in order to raise more money from investors. They don't just sell stock into the market because of liquidity and other issues. Instead, they find big-time investors such as hedge funds to sell stock directly to. They usually sell the stock at a small but non-trivial discount to the market value, perhaps 5 or 10% lower than the market price. But in return, the company is able to guarantee that they'll be able to sell the number of shares that they want to without tanking their stock price. A hypothetical arbitrager would love to be able to short the stock at the market price and then buy the stock through the follow-on offering at a discount to the market price. For example, say that company X's stock is trading at $100. Hedge fund Y might aggressively short 100,000 shares in the span of just a few days, putting downward pressure on the stock price. Let's say the stock ends up at $90, and that on the way down, hedge fund Y's average sell price was $95. Then they participate in the follow-on offering and are allocated 100,000 shares at a price of $80 per share. They take those shares and use them to cover the short position, locking in a $15 per share gain virtually risk-free, for a total profit in this case of $1.5 million. Easy money. As it turns out, the asset manager that got busted by the SEC did this 7 times within just 3 months. They did it with some stocks that are frequently traded by retail investors such as Plug Power, Sea Limited, and US Steel. For the Plug Power trades, the fund shorted shares of Plug Power just 1 day before the company filed a public prospectus, describing a follow-on offering of common stock. The average price of the shares that they shorted was slightly over $70. They were then allocated stock as part of the offering for a price of just $65. The almost instant gain that they made on this near arbitrage amounted to over $3 million. Of course, such trading is illegal and against US securities laws. The whole point of a follow-on offering is for companies to be able to raise a large amount of capital by selling stock, at a slight discount to institutions, not to the open market. What these arbitragers do is basically taking advantage of the discount provided by the offering and dumping them onto the public market, thereby unfairly front-running the company and ordinary market investors. The SEC's so-called Rule 105 explicitly bans this activity. According to the SEC, it is unlawful for a person to purchase equity securities from an underwriter, broker, or dealer participating in a public offering if that person sold short the security during a restricted period. The stated purpose is to, quote, foster secondary and follow-on offering prices that are determined by independent market dynamics and not by potentially manipulative activity, unquote. According to the SEC, the fund that got busted had an automated tool that should have let its traders know that participating in the offerings would violate the rule, but their traders simply ignored them. The company's legal department incorrectly calculated the restricted period. As a result, the firm was ordered to pay approximately $7 million in disgorgement of ill-gotten gains, interest, and penalties. Notably, the SEC said that because the investment firm was highly cooperative with the SEC in its investigation, they did not impose a civil penalty more than $200,000. Finally, we have another brokerage firm, WIS, that violated best interest obligation regulations and victimized retirees and other risk-averse investors. According to the SEC, 5 of WIS's agents sold so-called L-bonds to retail investors with moderate risk tolerances, many of whom were living on fixed incomes and would not be able to afford large investment losses. On the other hand, the bonds that they sold to investors were high-risk bonds from a company called GWG. Their business model is to basically buy life insurance policies from people who want to cancel them, then continue paying the life insurance premiums and collect the payouts after the insured people's death. The problem is that that business doesn't make steady income, and several years ago they issued bonds in order to fund a reorientation of the business. They characterized their own bonds as involving, quote, a high degree of risk, including losing one's entire investment, unquote. Some of the brokerage's agents marketed these highly risky investments to investors who are not what you would call highly risk-seeking investors. For example, one person who bought these bonds was a 79-year-old retired truck driver whose investment objectives did not include speculation. His annual income was just $35,000 at the time, and his net worth was about $300,000. One of the agents convinced him to invest $100,000 into these risky bonds. Meanwhile, the agents selling these bonds were earning commissions on each sale, collectively worth thousands of dollars. In general, about 3 to 5% of the value of each bond sold was awarded to the brokerage and the agents as a commission. This incentivized the agents to sell these bonds aggressively to people who should not necessarily have been investors. Because of this, the SEC says that the brokerage and the agents violated best interest obligations care obligation requirement by not exercising reasonable diligence, care, and skill, and recommended these investments in risky bonds to customers without a reasonable basis to believe that they were in the customer's best interest. The SEC has requested that the brokerage be ordered to disgorge ill-gotten gains on more than $13 million worth of bond sales, plus civil penalties. Alright guys, that wraps it up for this video. What do you think about these modern-day financial scandals? Let us know in the comments section below. In the meantime, thank you so much for watching, and we'll see you in the next video. Wall Street Millennial, signing out.